I don't know about you, but everybody is talking about rising costs. The prices are simply too high. And I'm about to tell you why these are going to be considered the good old days. You came here for the truth, so let me unveil that for you today. We got to talk about money. And it's going to be something interesting because I'm about to show you why things are about to get a lot crazier. Not just a little bit, not just incrementally, but we're talking about stratosphere up into outer space. Things are going to get wild. There are a few things that are coming in the next 2 months that you need to be aware of. I've talked about them before at length, and I want to bring them up again in this video. This will be the most important video you watch all week. First things first, the BTFP is ending. That is the Bank Term Funding Program. That's the emergency loans set up for the banks back last year in March of 2023. It was 1 year. It's expiring March. Who is most dependent on those? The small banks. The small banks are the ones that really need it as a lifeline, and that's about to expire. Keep that in mind, all right? Next thing, reverse repo is possibly going to be at zero as of March. Okay, reverse repos are there to basically like a vacuum to suck up the liquidity. If they are not there, something else is going to fill in the void, or else we're going to have some very big problems. And this is like, think about the plumbing of the financial system. Suddenly you've got a clog, okay? And then Fed cuts and QT, quantitative tightening, are up in the air. Whether it happens in March, some say that we will find out as early as February. So we get the meeting minutes of the Federal Reserve coming out, the month after. And so we'll find out where the Federal Reserve is at for March, but we're going to find out that in February. At least we'll get a hint at that. So all this comes down in the next 2 months, and you've got to understand what's been said ever since. Let me show you. Looking at it right here, JP Morgan, it's all over now, QT. Given the nascent discussion on slowing and stopping QT in the December FOMC minutes, a new information for the Fed leadership in recent days, we have to reevaluate our own projections. What did they say? Check this out. We now expect that the FOMC, these are the people that are actually voting, all right, on the interest rates, on the QT, all that stuff, okay? Will have the outline of a timeline at the January meeting communicated mid-February minutes to that meeting. We expect that this plan will be formally agreed to at the mid-March meeting and will be implemented at the beginning of April. All right, that's the plan according to JP Morgan. Are they going to be right? Time will tell. But if it's not in April, is it May? Is it June? I mean, they're going to signal something, and we know that that's going to come sooner rather than later, unless there's a catastrophic event, unless some major catastrophe happens, and then that sort of gets pushed back. But as of now, that's as of the conditions currently today. I know a lot of people are talking about this or that, but we need to just keep in mind we only have the information of today at hand. We think the Fed could be targeting reserves closer to 10% share of nominal GDP, and we envision QT concluding at the end of November. So they'll keep that going end of November, and eventually they will just say, okay, and that was it. We got down to, $6.5–7 trillion, and that's it. Where is it going to be? Where is it going to end? Well, we're going to find out. And ultimately, the more that they keep, the less they shed from their balance sheet, the more long-term inflation we will experience. So keep that in mind. Fed tiptoes towards dialing back channel of monetary tightening. This is none other than Nick Timiraos. Nick Timiraos is known as the Fed Whisperer, as in they pass information to him. He feeds it through the Wall Street Journal. So then it gets the market's reaction to it. So they can kind of see before they even say anything at any of the meetings. They put it through this guy, and you'll see what he has to say. Look, by slowing the pace at which its balance sheet shrinks, the central bank aims to prevent a messy disruption to the financial system. If you remember, if you've been watching here on this channel, I talked about this already. Lori Logan at the Fed brought this up, and I covered it not 1, 2, but 3 videos before, and now Nick Timiraos is bringing out into the Wall Street Journal. So keep that in mind, all right? There's a lot here that has been covered on the channel before it becomes widespread mainstream. Through the Fed stopped raising rates last summer, it is quietly tightening monetary policy through another channel, shrinking its $7.7 trillion holdings of bonds and other assets by around $80 billion a month. Now, that too may change. Fed officials are starting deliberations on slowing, though not ending, that so-called quantitative tightening as soon as their policy meeting this month. It could have important implications for financial markets. And there we go. You see? This is exactly what we were talking about. Lori Logan suggested that exact thing, and I know that it's so important. You could see the balance sheet there in the chart, and essentially what we're noticing is that at this time it's been declining, there's no question about it, but we will be left with more than what we started before. Not to mention all the cash in circulation that's been going on, printed 40% of all currency in circulation in a matter of a year and a half. We know that, but now that stuff is not going to just go away. Maybe a fraction of it does, but let's be honest. What's the most likely thing to come at the end of it all? More money printing, more cash being put out into the system. If it's not now, if it's not tomorrow, it's later. At some point, your currency is going to get another hit and another hit. And the people who get hit the hardest are those that are trying to save money, that are trying to, make ends meet. They're going to be punished. The people that own billions and billions of dollars of assets, they're happy because their asset prices just keep going up. They don't need to worry. And so this is what's going on right here. So let's get it straight. Right now, we have a bunch of events in March that could sort of derail the plans. Let's keep that clear. That's a problem. However, right now, according to data today, this is looking like they may, in fact, proceed or start to suggest that the quantitative tightening will slow. Not $80 billion a month. Maybe it's 60, or maybe they'll do it in stages. At first it'll be 60, then it'll be 40, then 20, then nothing. Maybe they'll go in that direction, and they could kind of lay it out there. Or they might say, okay, we're going to reduce it now, but we're going to play it by ear, data dependent, and so on. Then we got to look at interest rate cuts. They might signal right here, it looks very likely that they say we are likely to stop hiking interest rates, and at some point in the near future, we're going to decrease the interest rates because we don't want to overshoot on inflation. That's what the message is here today. I have been highly accurate. And why? Because I watch every single meeting. I've watched them all, and I've done that. I've read the books. I've done so many things, and they're pretty, it's a pretty predictable action when we look at the Fed, right? What happens in the economy, something occurs on the other side of the world. I can't predict that, but we certainly can look at what the Fed does, how they react to certain information. It's not an unknown. Let's be clear, okay? Especially when you've read as much of the history of the central banks as I have. That's my favorite part of this, is looking at the actions of the central banks, definitely, because they are the criminals. But anyway, this is something that I cover every single week on the Friday sessions. Just looking at the data in depth takes a very long time. I will spend like an hour on this type of thing in the live sessions. Finance Fridays, link will be in the description. We'll talk about that later. This is just talking about the stock market cycles, and you could see it over time. I want to make something clear. I just talked about this on the Friday session, and you could see it. Let's be very upfront. So we're looking at the dates, by the way. If I scroll down, you can see the dates. I'm trying to zoom in and give you a good look at that. The overwhelming bias is to buy. If you look at difference between calls and puts, bets that the market will go up or bets that the market will come down, the bias is on the calls, bets that the market go up. And over time, there's more buyers than sellers. The stock market goes up more than it goes down. The difference here is that the down is very fast and very painful. So it, kind of goes slowly on the way up, but when it goes down, it hits hard. It erases a lot of gains that people are making. So just keep that in mind over this period of time where people are kind of waiting for a crash or whatever. The vast majority of the time, if you're constantly doing that, then there's not that many opportunities, right? That's why in 2020, why everybody was saying either just dollar cost average, or other people were saying, sell everything. This is not the time. What I was saying was the best opportunity, because it's very clear that we're going through a part of the cycle. They're going to print money. They're going to do all the stimulus, and they're going to get things that make the market feel better, that, we can open up, no more lockdowns, all that stuff. Once that part was resolved, everything would open up again. And so you got to look at it like that, where, all right, at some point things are going to go higher. The better thing to do would be to invest in an inverse ETF, which is basically a bet that the market will go down, knowing that you've got your stuff over here, you've got your main portfolio over here. You're not going to sell that because you're going to say, you know what, I don't want to. It's in my retirement account. I'm not touching it. It's right there. But that doesn't mean you can't. People were telling you just dollar cost average, at the same time telling you that the market was going to come down. I mean, that's crazy talk. Why not invest in an inverse ETF to at least balance out some of that? But no. Well, I was talking about that on the channel here. So anybody that was paying attention here definitely got that information. You can see the rate cut expectations in 2024. That's where they're thinking of going. It is several cuts. The expectation of 6+ cuts. I'm not so sure about that, but that's what the market says. That changes day to day. But that would mean significant cuts from this point. Okay, that's most of what they did. So are they going to do it? I'm not sure, but we'll see. I mean, a few seems to be likely, but 6 would mean there's something going on. Among the key reasons for the decline of inflation of the past year were a drop in energy costs and supply chains that had largely ironed out the problems through 2020. The Red Sea turmoil hampering both of those disinflationary forces that central bankers were hoping could help finish the job. This world is fragile. We begin on the supply side. You get the additional shock. It happens, and so on. Look, you got to realize there's always going to be problems. There are always going to be these issues that come up, and you don't know if it's going to be in the Red Sea, or you don't know if it's going to be something with the housing market or the cars or anything. We don't know that, but we have to react as that does come up. All right, and then this is just showing us the delinquency rate of the top 100 largest banks versus all others. And guess who's got problems right now? It's the small banks. The smaller banks are the ones that are dealing, in fact, the highest ever. This chart goes back to 91. We are experiencing the highest ever delinquency rates. So of course, this is credit cards, by the way. Of course, this is a problem. And you can see it coming through in all of the data. If you want the information that there's just not enough time in YouTube videos. There's just not enough time. And I keep the best stuff for the live sessions because I can just expand. I don't need to worry about algorithms and all that stuff. And 2 hours every single Friday, we get into that. And I hope that you'll join me on there as well. There will be a link in the description. And if you want to support the channel, simply hit that thumbs up button. And I'll see you tomorrow. Take care.